Well, welcome. Thank you for coming to Property Pub 2025. I am Brandon Johnson, and on behalf of Voight Johnson, my partner Heidi is around. There she is back here. Wave. Thank you for coming. Just want to introduce, we have a few agents here. Want to look and wait, raise your hand so I don't miss anyone. Scott Shosted, Jamie Heisenga, Deb Feeney, Rachel Kubski, and Emily Schmidt. I don't think I missed anybody. But little housekeeping, feel free if there's more drink tickets, we want to make it as welcoming as possible, so feel free if you want more. It's no means are we cutting anyone off, so just help yourself, grab a few drink tickets. We're only here till 9, so it won't get out of control. But the purpose of this event is to kind of have a customer appreciation network, kind of mingle, but also provide a little bit of real estate and financial advice. And the theme of this panel is protecting your assets, and we'll get into what that means in the broad range as well as how it relates to real estate. But I just want to invite you, this is our second iteration of this. We did this last Monday as well. And so it really works. Open it up. If you guys have questions, it really is fun when it's interactive. Raise your hand, play Stump the Panel. That always worked well. We'll try and get back to you if there's any questions. But feel free to just shout out questions. Anything that the panel says, feel free to engage. It really makes it for a more interactive event. So with that being said, I just want to turn it over, and each of you want to give a brief introduction, a little bit about yourself. Andy Jacobs with Jacobs Financial, Lori Athman with JDA Law, and Michael Brower with American Family. If you guys want to just give a little quick bio, and thanks for having us.
Great, yeah, thank you. My name is Andy Jacobs with Jacobs Financial. I'm one of the senior partners, wealth management advisors. I've been doing this for 21 years, something like that. I'm third generation. Our company has been around for 52 years this year, and we have other advisors, and one of them is here today. Matt Sutter is over there. So he's here just to poke fun of me, I think. So we focus on investments, retirement, and insurance planning for individuals, families, businesses, and professionals. We also do a lot of 401k plans for companies as well. On the insurance side, it'll be the areas that we focus on specifically life insurance, disability, and long-term care planning. So those are kind of the three areas. We do other areas, but we usually will bring in other folks, such as like Mike, and that focuses on the other areas. So that's me.
Thank you.
I'm Lori Athman. I'm from Jovanovich, Daigie, and Athman, which is why we go with JDA, because we don't say that name, at least not 3 times quickly. So we're a general practice law firm. We're right in the Belka National Bank building. We've been there for almost 19 years now. I've been an attorney for 20 years. So there's Sue Daigie and myself as a partner, and then we have Tammy Stafford, who also works there. We're a general practice, so that means we kind of cover everything. My niche is kind of the estate planning, so the wills, the trusts, healthcare directives, stuff like that. I also do some of the medical systems, helping people through that process with accounting when that time comes. And then I do family law and landlord-tenant law. That's a little bit about me.
Michael.
Thank you. Mike Brower. I'm with American Family Insurance. You'll get the same jokes if you were here last week. But I've been doing this for about 111 months, and so we're still going in the months. I've been an agent myself for just over 2 years, and with American Family, we're focused primarily on risk management. Generally, your home, your auto, your toys, some life insurance. We do a little bit with commercial insurance, but all of those things that you work for, those things that you dream about, we help to make sure they're protected and able to be restored if something bad happens, and that's what we like to do.
Cool. So what we're going to do is we kind of have the questions in 2 halves, so we'll break it up in 2 parts, and we're going to start off with kind of the foundational aspects of what these experts do, and then we'll get into what's changed and what the current market looks like and how to adapt and how to navigate in that current market. If you all have been kind of paying attention, it's been about 2.5 years where interest rates kind of doubled in the matter of a month and a half, and that really changed the aspect of real estate, and we're kind of in that new normal now with rates hovering, in the upper 6s, around 7. But I always say when you buy a home, when a lot of people purchase a home, you're buying a payment. So whether that house is $350,000 or $400,000, most buyers come and say, I can afford $1,400 a month for principal, interest, taxes, and insurance. And what does that equate to the purchase price? And that's the price of the home that buyers go shopping for. So when interest rates fluctuate as dramatically as they did a couple years ago, that really changes, it upsets the apple cart, and you really got to adapt. So we're going to talk a little bit about that, because a $350,000 mortgage, you're paying about 40% more than you were 2.5 years ago. So that's significant. So we'll talk about that, but we're going to start with kind of the foundations of protecting your assets, and I'll start with you, Lori. Tell us, one option is owning your home in your personal name. Another option is owning it in a trust. Can you first maybe just tell us what is a trust, the benefits of that, and then why you would put real estate into a trust?
Okay, so there's two different kind of trusts. You can have a revocable and an irrevocable, and they're exactly what they sound like. You don't see too many irrevocable because it's a permanent decision on your assets. Once you make a irrevocable trust, you can't change it. Sometimes you can't even change who's going to handle those trusts and what they're going to do with it or how they're going to manage it. The other more common is a revocable, and that's exactly what it sounds like. You can put your assets in and you can put it into a trust, you can take it out, you can sell it, you can do everything you can do in an individual name. So why would you want to do a trust? A lot of times it's the most easy and cost-efficient way at the time of your death to handle all of your financial affairs, okay? So a trust is not going to avoid medical assistance. So you can't just throw everything in there and say, well, now I don't have to worry about a medical assistance lien. It's all still subject to that. But if you have property in your individual name, then at the end of the day, you have to go to probate to have all those assets transferred to the next person in line. Because you kind of think about it, if your real estate is in your individual name and you pass away, who has authority to sign the deed to send it to the next person, right? Which is why you then have to go into court to get that all figured out and get the court's blessing and authority to get it all transferred. So by doing it in your trust, whoever your trustee is just handles it. They have the authority to transfer the property, to liquidate assets if that's what's best, to handle the taxes and everything like that. They don't have to go to the court. So by probating it, it can take up to 9 months to a year to get done, just because it's a process governed by statute. So you have to do step 1. When you do step 1, then you have to wait 2 weeks before you can do step 2. Then you have to publish it in the newspaper, and that has to be 2 weeks, but then you have to wait 4 months for creditors to come. So it's just this whole long time that can take it 9 months to a year. So that's why a lot of people like to do trusts, is it's just the easy way to just transfer everything, have the one person handle everything, and you don't have that time and expense to do it.
So on a revocable trust, you can amend or change who the trustees are. What can you change? Are there anything you can't change, or what are some of the common changes that you see as time goes by with the trust?
So you can change anything. My record right now is they have 11 amendments to their trust. So they've come in 11 times and said, I want to change this, I want to change that. So I think some of the most common ones are the trustee. Maybe their trustee became ill, they moved, they passed away, something like that. I think that's probably the most common one. Or maybe they got real estate or inheritance of their own, and now they got to kind of think about what do they want to do with that. So they have a provision that specifically addresses that. I've had sad situations where maybe children got involved into drugs or chemical dependency, so now they want to amend it so they don't get this large amount of money that is probably going to go to, drugs or alcohol or something like that. But I would say those are the most common, that there isn't anything you can't change in a revocable. You can even revoke it if you want. You can just say, I don't like this, I don't want to do it anymore, which I've never had anybody do, to be honest. Usually an amendment is enough to get it back online with what you want. Because a lot of times you can do, people will have a trust and they'll come in and they say, we want to update the trust. And I say, okay, well, what don't you like about it? Well, when we did it, our kids were 2 and 4, and now we're retiring and they're out of college and they have a whole different plan, right? So it's very fluid. You can choose
Versus a
what you want.
irrevocable, you can't change anything.
No.
Gotcha. Yep, like a tattoo. Anybody have property in a trust currently? A few of you? Yep, it makes sense. And we'll get into kind of how some of the other intricacies with those as well. Andy, question for you. Obviously, financial planning, the first thing to think of is equities, stocks, but there's more that goes into your financial portfolio per se. What sort of things do you recommend as far as different types of insurance, or give us some broader things that you recommend for some of your clients other than portfolio mutual funds and stocks?
Sure. I mean, your base or your pillars is going to be your insurance, which is really important. I asked this question last time. What do you think your biggest asset is? So,
I heard your house.
Earning potential.
Earning potential. Yeah. So
Spot on.
Yep. Spot on. Right. So, like, if you're not working, right? How are you going to pay for everything? So, your income protection, your disability is going to be one of the biggest pillars that you should have in your working years, for sure. So, typically, you would get maybe 60 to 66% of your income from your employer for a disability policy. If you have a claim on that, you're taxed on that. So maybe you only get about 40, 45% depending on your tax rate. So something to consider. Do you want to bridge that gap? Look at that. If you had a claim, what is your actual income payment going to be from your disability, if it's taxed or not? And will that be enough to pay your mortgage? I mean, like, you're trying to protect your home in this case, right? One of the largest reasons for foreclosures is going to be disabilities. So that's a big one. Life insurance is another one. That's pretty clear cut, right? If you pass, boom, cash, tax-free dollars that goes immediately. That can replace, income, pay off a mortgage if it makes sense to do that. And not have those expenses. So those are some key ones. Now, as you age, even not necessarily age, because you could have a claim on the long-term care side, meaning that you can't maybe do 2 out of 6 activities of daily living that would qualify for that. This is protecting your assets. So it could really be a wealth destroyer, if you will, if you don't have the right benefits in place to be able to protect some of those assets. For example, in 2023, Genworth study, they're like a huge provider for long-term care. What do you think the average annual amount would be if you needed care from someone, like in-home care from like not assisted living, but like a home health care provider? Just take a guess for the St. Cloud, just for a second. Annual amount.
95,000.
Yeah, you're really close. Like 113 or something like that. It's
crazy.
It's actually higher here than it is in Minneapolis.
Here's another beer.
Yeah. Assisted living is like 103 or something like that. Like a full, like semi-private, full private's like 149 or 150. So anyway, you can get the idea. Like, that's 1 year. So like your assets could be completely just, right, destroyed really quick. So like there are certain things you can put in place to help that, and that's where some of the insurance products that come into play. I can talk more about that.
Yeah, we'll come back to that. Maybe, and then we didn't talk about this last time, but life insurance, when would you, there's term, variables, annuities, when would you recommend, explain the difference between maybe a term life insurance, a variable, different objectives, and when you would recommend or when it would make sense to do one and not the other?
How much time do we get?
The short version.
All right, short version. Okay, so term is just terms, just straight death benefit only. You have it for a term time period. Could be 10 years, 15, 20, 30. It just depends on the carrier and what you're buying. And it's just a death benefit, and that's that term period. And it pays out, tax-free dollars if you die within that time period. There you have it. Permanent, which Randy mentioned, like variable and there's index. There's always different what we call cash accumulation. Permanent policies where you can earn cash. So it's maybe a different approach where you have it for a lifetime, and depends how you structure it. There's many types out there. Whether it's using it for the protection, it's always the protection, but you can use it more on the accumulation side. So there's ways to structure it to accumulate an asset, the true asset that's in there. And it can be used for a lot of different things. I mean, I've had a client that needed a down payment for a house, actually.
Yeah.
And we used a loan out of his cash value, so he didn't have to take a loan out of his 401k or grab monies that might be taxable and things like that.
Question.
On that cash value, is it only what you put into it already that you can take a loan against, or is it against what it'll eventually pay out upon your death?
Like how to get the money out.
So if you had a
cash.
$500,000, let's say, I don't know if I got the word, a term or life or whatever the types are, let's just say you paid for the term, whatever you paid, let's say $50,000 into it already, but it's worth $500,000. Is he able to borrow only against what he's paid into it, like the $50,000, or the $500,000 that it's eventually going to be worth upon death? Or
Yeah, sure. No.
What's he able to borrow against?
So there's a couple ways of getting that money out of permanent for cash value. One would be is you could take your contributions, like in your example, 50,000 or 100, whatever you put into it, say it's 50,000. Let's say the cash is worth 200. You can take your 50 out, because that's first in, first out, and then that's your cost basis without any taxes in it. The earnings would be taxed as ordinary income if you did it that way and took a lump sum without doing a loan. If you want to get the earnings out tax-free, then you would have to do the loan, and then you just pay yourself back at a really low interest rate within there. And there's no time periods on it. It's structured however you want when to pay back.
Right, because I think I sent you out, I haven't listened to it yet, but that's what they're talking about. Like essentially, you can be your own banker. Instead of the bank, you can be your own banker, and it goes based on, which it's kind of out of box thinking.
Correct.
It's the $200,000 to $500,000, which is
You give yourself a lot of more options, right? Yep.
You get more options, more flexibility.
so it's based on that.
Yep.
Thank you.
Yep.
But you do have to pay attention to tax ramifications, right? Potentially, it's a more complicated type of transaction.
No, a good question though.
That's a lot of that one.
Shifting gears, Mike, insurance. So the insurance world, and I know you brought a kind of a neat article just out of the Star Tribune here this last week, but what we've seen nationally, and I was made aware, like I mentioned to you, that in the last 2 years, Minnesota ranks the third highest state for number of claims nationwide, only behind Florida and California. What are you seeing the appetite for risk from an insurance and underwriter when someone's coming in to apply for a new homeowners policy? How is it different now than even just a few years ago?
Sure. Great question. And I would say it's just a lot more selective than it used to be.
Yeah.
There is a lot more underwriting variables that are going into specifically homeowners policies. The property market, the article that I brought Kind of talks about what we've been seeing the last couple of years in the property market. I'm sure all of you have opened your homeowners renewals and you've been really excited to send more money to your insurer of choice.
So, sorry to interrupt. So,
Yeah.
what you're saying is indirectly, even if you don't have a claim, just the nature of the macro environment is indirectly affects all of our premiums.
For sure. There's definitely that aspect. When you talk about insurance, for those that are well versed, you understand this. For some that maybe aren't as versed in insurance, essentially you're putting money in with your insurance and pooling that risk. All of the insurers are putting money in. When there's a claim, some of that money comes out. And with what's been going on in the industry nationwide, but specifically in Minnesota, is the claims that have been paid over the last few years have been exorbitant compared to the premiums that have been received. I think I mentioned last week, but I believe it was 2022, and in that year they looked at the insurers in Minnesota, the premiums that came into the insurers. For every dollar that came in, the insurers were spending about $1.90 in
That's
claims.
crazy.
Yeah, and so they did that for a number of years. And that is the insurance game. Everybody knows, that can happen. That's part of it. With the rising costs of everything, the rebuilding costs, the prevalence of claims, all of that has just been a perfect storm, if you will, to create a really difficult thing for insurers to continue to underwrite, continue to manage. And we're seeing that a lot through rate. We're seeing some non-rate actions, things that the companies are doing on their own to reduce costs, reduce expense, those kinds of things. But we are still seeing it happen in rate by and large over those last couple of years.
Yeah, some of the things we're seeing on the real estate side is it used to be, when I say used to be, 4+ years ago, when you as a buyer would go and get your home loan and you'd provide all those documents to your lender and they'd keep asking you for more tax statements, more pay stubs, all of this, and then they'd say, oh, you're clear to close, go get your insurance binder, 2 days before closing, and then send that to the title company.
Just on the way in.
Yeah, so the homeowner's insurance policy was kind of the last thing. Nothing, there was no reason why it could go wrong, right? That is not even, it's night and day currently to what it is now. So what we're recommending is that's one of the first things you want to do. Not necessarily that you won't be able to obtain insurance, but what we're seeing is the history, even if you have perfect, no claims that you've ever made, the house you're buying, if there's been a history of a number of claims on that house, that could impact the premium you're paying. That could impact if a particular carrier is even able or willing to underwrite that home. And there's other options. There's the Minnesota Fair Plan, which is insurance through the state, which is at a higher rate. But I didn't want to speak for you, but you would recommend.
You're good.
No, I would recommend you want to get in and see your insurance agent sooner than later to know if there's anything out of the ordinary that you wouldn't typically be accustomed to, correct?
Generally, what I try to advise my clients is if you've submitted the purchase agreements, you're in that process where you want to buy this place. That's a good time to give your insurance agent a call or an email and say, hey, I'm looking at this place. We think we might be closing in 4 to 6 weeks or whatever it might look like. And can you get a proposal put together? Because that gives us enough time to get that quote together, research the property a little bit, find out if there's any issues. A lot of what we're seeing right now from an underwriting standpoint is related to roofing, ages of roofs, conditions of roofs, prior claims. Those kinds of things are the things that underwriters are much less likely to write if there's a concern there. And so when we're having to go outside the current underwriting appetite, that's when it can be a little bit longer process. We might be looking with American Family. If American Family can't write it, we might be going to our brokerage department and saying, we've got this, and we can usually find a home for things unless there's really a condition issue. But that process is definitely taking longer than it was 4, 5, 6, 10 years ago.
Sure. You got a question? Deb?
So, can you speak to like this, the age of the roof? Like, are there some, not just with American Family, but generally, like some insurance companies that won't touch insuring a roof if it's older than X number of years?
X number is the key. What I can't speak to is what all other insurers are doing because everyone's underwriting appetite is a little bit different. There's a little bit, American Family right now, generally speaking, we're looking at new clients coming in and we want to see that roof less than 20 years old. That's where we're at right now. That adjusted toward the end of last year. That could change as things goes on. 2024, for example, we had a better year in Minnesota as far as those kinds of wind and hail claims. There's still some other things that were in Minnesota that it'll shake out as far as claims go, but we don't think it was as rough of a year as 22 and 23 were. So that is good. That helps some of the underwriting appetite. But right now, that's the range that we're in. I've heard of some other insurers that won't write anything right now beyond 10 years old. We actually heard of one. It's all rumors, so I can't say this is accurate, but I heard of one where they were saying they weren't going to take a roof over 5 years, and that seemed unheard of to me. I've heard of some others that they are still writing based totally on condition, not upon age. That, again, it's an underwriting determination made by each company, what they're willing and able to do, what their risk appetites are. American Family, I'm grateful that, we're still writing business in Minnesota. We've had quite a few of our brokerage departments and some competitors that have said, no, we won't do that for this season. And so we're seeing that as well.
Yeah, but the real world environment now is just the idea that there is heavy scrutiny in underwriting where it didn't used to be that way. Correct?
Absolutely,
Yep.
absolutely. And as agents, we want to write business. The underwriters don't necessarily, they don't have the same compulsion to write new business, but they are also under much, much more strict guidelines because they want to make sure they're putting the right kind of business in so that we are able to be there for our clients if the claim happens. Ultimately, that's the insurance part that if we're not there to pay the claim, it really doesn't matter what we did on the front end. We've got to be able to do that on the back
Yep.
side.
I have a question.
Yep.
And just because I've run into this even with new agents in the industry talking about roof claims and stuff, and we're always negotiating stuff, right? And in a recent transaction that I was negotiating a roof claim, the other agent that was representing the buyer presumed that we were going to be dealing with $1,000 deductible. And what I have experienced in my own experience with working with Mike is that you're able to maybe